have changed liquidity in the market and have changed hedging behavior in the market. And so it's kind of a little bit of a deeper dive into, yes, oil prices have halved, but what does that mean when for the people that have to interact with the oil market every day, and what does that mean in terms of what's going to happen to energy prices over the coming weeks and months. So I guess this is kind of a deeper dive under the hood, a little bit more than why oil prices have halved in the past 6 months.
Hi, thank you, Morgan. That more or less says it all. The fact is, when energy prices drop by a factor of 2, interesting things happen to all of the related tradable products that many market participants are exposed to. And the intention here is to explore some of the issues that arise, both on just pure spread behavior, as well as the implications for hedging strategies that are affected. We'll also touch a bit on the nature, having to deal effectively with this sort of price volatility at the same time that liquidity is limited in some markets. So you're forced to make decisions that are often requiring estimation and statistics, as well as in order to develop hedging strategies that are actually effective. So to that point, we're just going to proceed forward now. Even though we talked about, in a sanguine nature, the 50% drop being old news, we're going to start by effectively reviewing that, but as Morgan said, in a more holistic context. So the first slide that has anything in it really is the picture of four commodities, effectively Brent, WTI, Central App coal, and NYMEX natural gas. Right now we're getting there, so just bear with us for 1 second. And the picture is familiar to everyone in a fashion. Oil has, in the last 6 months, plunged. Central App coal, NYMEX natural gas have been on their downward creep. You look at that, and you certainly don't say the word bull market in spite of the little tiny uptick afterwards. While these pictures are interesting, a trivial modification I find more illuminating to begin to look at the relationships between things. And that's in the next slide, which is the trivial modification simply being let's normalize everything to an initial reference price, which by pure randomness we chose to be at the beginning of 2012. It's long enough to begin to see the trends, and you can certainly see that oil, WTI and Brent track each other very closely. The demise of Appalachian coal and natural gas predated that, and for different reasons. But again, you get an idea of what's changed. Now, when we go to the next one, now we're going to begin to proceed into related products. These are normalized prices, and we'll do everything in the next couple of slides in this context. And also, I should comment, these are rolling calendar strips. Seasonality is an annoyance, and for this sort of macro-ish view, it's just easier to average it out effectively. Here you see that basically distillate and RBOB are tracking WTI down step by step, and we'll see later that the relationship between these was shockingly stable during this sell-off. That'll impact how hedging strategies perform when we get there. And finally, the last real, if you like, macro-ish price trending slide relates to power. And here the idea again, calendar strips, normalized prices. The non-red plots are basically anything that you could conceivably argue has an impact on North American power prices in the way of fundamental fuels. And the red one is PJM Western Hub calendar strips. I'll take PJM. Many of them would look the same, simply because it's kind of one of the well-known and liquid hubs. And of note here, we'll go into this more also after changing tack in just a moment, is that the demise, if you like, or the sell-off of the red line of the power markets was actually a little bit muted relative to natural gas, which is the blue line, and that turns out to have substantial implications for how you actually manage power positions in a situation where liquidity, especially at longer tenors, can be severely limited, at least in this day and age. So handing it back to more.
I just have one quick question. Could you just elaborate a little bit on the heat rate expansion, the relationship between the heat rate and
yeah, so you know, probably the best place to do that will be in a few slides when we actually show heat rate expansion relative to natural gas prices. But the short answer now is that as prices drop, there are a couple of things that can enter into it. One is bidding behavior that has certainly fixed costs associated with it, as well as just the way the power stack works. You can roll to other fuels, into or out of natural gas, which ultimately, those are the basic reasons for it occurring, and it's statistically pretty well established in many months. So we'll hit it again when we get to the hedging slides.
Actually, and then I have a question there just in relation to the price movements. So we're obviously bundling energy all together into one kind of macro set, but would you say that it's causation or correlation, the fact that oil sold off at a similar time to kind of the electricity complex of coal, natural gas,
well,
power?
That's a really good question. So if you look at this, you can clearly see that I mean, and this is an old story, and that's a continuing to unfold story. But the fact is, natural gas and power and even coal were selling off way before the plunge in oil prices. In fact, when it occurred, and I'll defer to you on this, you even had a fair amount of discussion about, do people in the global economics world know something that no one else does about 2008 redux? So here, I would argue that early on is for completely different reasons, but then ultimately, once things really start hitting the iceberg, it does look like there was a kind of a joint effort across the board to sell off. And you may have.
And I guess there would be some correlation in that the underlying fracking, the emergence of fracking started in that gas, almost kind of a late arriver, 2009 started to arrive to oil. But it's kind of interesting that people have been talking about the whole oil as a transport fuel, natural gas is potentially a transport fuel, but that arbitrage, there's not really much there in terms of a arbitrage.
Fungibility between them, effectively.
Between them.
Yeah.
And so
it's a good question. In fact, this sounds like a family reunion, because back in the day, in one of our earlier webinars, we even talked about the fact something that we floated was the idea that with the production of shale gas and oil, that you could see a sell-off in oil actually being bullish for natural gas. Namely, if you produce less oil, or then you're going to produce less natural gas. So, but that hasn't panned out, right? Everything's gone down in tandem. I saw no evidence from these series to suggest that hypothesis that at least I mentioned is correct.
So I guess there's a correlation on the supply side in that you've got similar technologies, fracking, being used to produce oil and natural gas at the margin, but on the demand side, there's not really much correlation as much on the demand side for oil and gas.
The switching abilities for power generation, that's not going
to. And do you think over the next, say, medium to longer term, 5 years, do you think is that going to change, or is it that demand side correlation for nat gas and electricity with the emergence of CNG cars and electric vehicles, or slightly more electric vehicles? Do you think that correlation?
Well, I haven't seen estimates on what people anticipate for CNG consumption. It would be hard to imagine, I'll go ahead and stick my neck out, and you can tell me if you disagree, that you're going to go back to the days where you're plotting the ratio of crude oil prices to natural gas prices.
Which was a big thing.
Which was a big thing back in the day. And that, I think that's gone the way of the dinosaur. I don't see too much coupling it, but that's just a personal view. What's yours?
I agree with you. I think that, you're going to have a huge shift on the demand side in the not just the U.S. globally to get any sort of correlation on the demand side between natural gas and oil. But there was a lot of chatter about that a couple of years ago.
Yeah.
Because oil was very high, natural gas was so cheap, the spread was so wide. That chatter has kind of died down. But it's interesting that it looks like they're correlated, but they may not be correlated.
Oh, absolutely. In fact, the fact that we threw these on the same plot was not to imply that the whole world was suddenly all coupled. It's more simply because they do feed power in one way or the other. They affect things a little bit, and certainly coal and natural gas do. But in fact, I would even argue that these slides, even going back to the earlier one, not to flip there, would suggest that the phenomena are quite distinct. So that's it's worth noting. So I think we're heading to drivers, Morgan.
And this is just a kind of I'll run through these few slides relatively quickly, just to give everyone a recap of what were the main things that caused oil to collapse starting in August of last year, because it kind of happened really suddenly. And up until even June, July, there was, we had been at $100 for WTI, give or take, or $110 for Brent crude for 5 years, and that is a long period of time, plus or minus $10. So the market was was not very volatile, and it was stuck around pins to that $100 price point. So what changed in August of last year to cause a halving of prices? First of all, you'd obviously have had the inevitable increase in U.S., and I've added U.S. and Canada here together, U.S. fracking supply of oil, which pretty much started in 2009. It's an old technology. It was first used in the 1950s, as everyone knows here. It started as kind of a renaissance in the 1990s and 2000s in natural gas. Natural gas is much easier to frack than oil, but it really took off starting in 2009. And the reason it took off in 2009 was because fracking requires, it's a very expensive process. It requires, there's a big debate of what price does fracking require, but it requires a much higher price than conventional, you drill straight down and produce oil type production. So the debate is it $50 for fracking? Is it $75? There's obviously there is a cost curve associated with it, but it requires a high price, and oil prices being at $100 for 5 years did provide that price for U.S. fracking to take off. And what happened was the U.S. increased production, U.S. and to a lesser degree Canada, and you can see from the blue line here, OPEC or the rest of the world outside of the U.S. and Canada, the oil production went sideways for 5 years. And so that was kind of the background of the 2014 August sell-off. Go to the next slide. But here's what kind of kicked us over the corner. So this is global 2015 growth estimates. And these are from a survey, I believe it's the IMF. And so back in August of 2014 rather, that's when we started to turn the curve, or the inflection point kind of the reduction in 2015 GDP growth. A lot of these, this GDP growth reduction came from China, I guess the BRIC countries, Brazil, Russia, India, China, but primarily China and Brazil. And so you can see that was kind of the trend started in August 2014, and that trend is still continuing lower. Chinese demand and Brazil economic growth is still falling, or the consensus is that it's still falling. And so that was kind of the underlying driver of demand growth for oil is falling. Then this is kind of may look a little bit kind of complicated here, but this is OPEC, unexpected OPEC outages. This is where through wars, through industrial disputes, but primarily through military and action, how much OPEC is not producing. And you can see that beginning in August of last year, Libya, which as everyone knows has had a lot of issues there for the past few years, but in August of last year, the political situation in Libya didn't really stabilize, but oil production in Libya recovered by about 1 million barrels per day over a period of 3 or 4 months. That has since unwound, as in that this driver has kind of since been taken out of action. Libyan supply is again down to 300,000 or so barrels per day. It had been much higher a few months ago. But this additional 1 million barrels per day starting in August of last year did push oil over the edge. So you had the combination of those 3 big factors. You had U.S. oil supply continue to grow. The growth was around 1.5 million barrels per day of additional supply coming out of the U.S. You had demand, so economic growth slowing, and then you had this additional kicker of Libyan oil supply starting to recover in a dramatic way beginning in August of last year.
Has there been any change in OPEC's stance since we last spoke? I mean, is it still sort of the same? They're just trying to. Yeah, what's the update on OPEC?
Yeah, so the OPEC has not met since November of last year, and OPEC, everyone just looks to Al-Naimi, the Saudi oil minister, whatever he says goes, and the Saudis have met with a bunch of Russian representatives since November of last year, and there's kind of chatter that Russia, which is 10 million barrels per day of the 90 2 or 3 million barrels per day of production. Saudi Arabia is roughly 10 as well, so they're two huge oil producers. They've been meeting, and you've got to imagine that Russia's in such dire straits that they will go along with, at least verbally, any potential OPEC or Saudi-driven cut that the Saudis would suggest. Right. So there's a lot of there are meetings behind the scenes, and well, they're meeting public. Their meetings are known publicly, but the meetings are off the record. And so there's talk about Russia is trying to get the Saudis or OPEC to do something. There's a lot of OPEC oil ministers outside of Saudi Arabia, Nigeria, and Venezuela, and whatnot. The market kind of ignores what those people say because they don't. They're just kind of along for the ride of whatever the Saudis say. But there's nothing set for.
Nothing new behind the scenes that we're
no, just chatter.
Okay, just curious.
And so this is kind of a net result. Demand is growing and still is growing. People think demand is shrinking, but oil demand almost always grows. It's growing by just under 1 million barrels per day last year and this year. Supply had been growing last year at 2 million barrels per day, of which 1.5 was the U.S. So someone needed to take 1 to 1.5 million barrels per day of supply off the market. Otherwise, that oil is just going to go into storage tanks, which is what has happened, which has affected a whole bunch of spreads, which we can talk about in a few minutes. You can see that this is from the EIA, the U.S. government. The cut in production, that 1 million to 1.5 million barrels per day, if you look at 2015, 2016, that cut has not come from OPEC. It's come from all these North American frackers up in North Dakota and West Texas. They had been growing production at 1.75 million barrels per day in 2014. If prices did not halve, we would still see another 1.7 million barrels per day production increase in North America, or we should have seen. But you can see that the prices halving or falling by more than half has forced the U.S. to take the position, U.S. independent commercial operations to take the position of what OPEC had traditionally done. And so the oil market has reacted. Most of that reaction on the supply side has come from North America. It's just you can see, if you look at oil inventory numbers over right now and over the coming few months, it is going to look incredibly bad. But just like any trader, you've got to look through the numbers to the second half of this year and first half of 2016, such that this is already priced into the market that we are kind of off the curve, off the chart. That this is like the amber range is the inventory of crude oil in the developed world, OECD, and as you can see, we're pretty much at making new highs in terms of the amount of oil in storage globally. This is a global chart. And if you go to the next one, this is the U.S. You can see that we're at all-time highs in terms of crude oil inventories. So the previous chart was international, the OECD, just narrowing down to the U.S. And then you can kind of see a little bit of an under-the-hood type data. Gasoline inventories are at record highs, but distillates, which is diesel and heating oil, are close to the lows. And so that kind of affects spreads between refinery margins and relative value of heating oil to gasoline. And it's one of the interesting things that if you, as I mentioned before, if you pull up to the pump in the U.S., everyone kind of is always looking at why is diesel at $3 a gallon or $3.50 a gallon, and gasoline is $2.50 a gallon. If you look historically, up until 2004, diesel was always 10 cents a gallon cheaper than gasoline, even during the winter. Now it's $1 a gallon more expensive, and this is one of the reasons for this. And this kind of all kind of hooks back into the U.S. has got a ban on crude oil exports. So what refineries in the oil market is effectively doing as a proxy is exporting diesel to the rest of the world as a proxy for crude oil. So it's kind of a distortion driven by the U.S. crude oil ban.
Right. So we'll take a look at spreads.
Yeah, so on spreads, we're going to march through a few here related to the refined products markets as well as power and natural gas. The next slide shows the rolling calendar strip view for diesel and for RBOB. And the punchline here is that spreads move. We'll see some more about that in just a moment. But that it's certainly not a good time for refiners. And the question then is, it is a topic certainly close to my heart, is how do you hedge a basket of products with something simple like crude, or later in just a moment with natural gas. Can you skip? I think we have a slide out of order. Go forward too, and then we're going to go back to that other one. So here, this is continuing on the crack spread thing. One of the questions that I'm always interested in, I think, is pertinent to the crafting of hedging strategies is, how do you hedge one thing with another? Now here, liquidity in the underlying products markets is tolerably high. Morgan can speak to that, I think, later. But nonetheless, it's not uncommon to be hedging a basket of product exposure with an underlying crude benchmark. It's convenient, could be cheaper. And so the question is, how much should you hold? And this is a topic that spans far more than just this particular context. Not all barrels are created equal. Not all MMBTUs or megawatt hours are created equal. So when you're thinking about crafting proxy hedging strategies, you have to think about how much is the right amount to hold. The picture on the left, and this is a primitive analysis. I mean, you could hardly even warrant the word analysis. It's a caricature of this very question. The plot on the left shows the ratio of RBOB to WTI versus the underlying WTI price. Now, this is a mislabel here. The underlying price should be labeled WTI dollars per barrel, I just noticed. But what's intriguing about it is, one, it's always above 1 historically over this range included. But more interestingly, it stayed shockingly stable during the sell-off. Clearly, prior to that, it had bobbled around, again, in the rolling calendar strip sense, between 1.1 more or less and a little above 1.3. But during the sell-off, it stayed right around 1.2. And the relevance of this from a risk management perspective is simply to illustrate the distinction between the beginnings of crafting a statistically based hedging strategy versus a naive one of all barrels are created equal. The plot on the right basically shows what would have transpired to your world if you were hedging a position from September of 2014 through the sell-off. And one is basically using the 1.2 ratio that transpired, nonetheless, midpoint that you would have selected in advance of the experiment, versus using a naive hedging strategy of simply using a 1-to-1 hedge ratio. And neither of these is perfect, but certainly the range of outcomes spanned by an incrementally more sophisticated look at the world is better than a naive one. And so that's the essence of this is, one, the stability was remarkable during the sell-off, and second of all, you really do have to be paying attention to how much, what your hedge ratios are when you're doing the proxy hedging. At that point, I think it's back to the diesel gasoline spread.
And this is just to give you some kind of historical perspective on what I was mentioning earlier on. You can see heating oil is obviously used in the winter, and so diesel and heating oil kind of blended are very close together in the refining mix, and so these spikes are usually around January or December every year. But you can see that before 2004, diesel historically had always been very close to gasoline prices, and on average had been higher in the winter and lower in the summer, but on average it had been roughly 10 cents per gallon for the longest period of time, 10, 15 years, underneath gasoline, and it was a very stable relationship. So you can see beginning in 2004, and what happened in 2004, that's when crude oil, we moved into the new world of $20 plus crude oil for the first time. We've never gone back. And so beginning in 2004, that relationship between diesel and gasoline in the U.S., and these are retail pump prices, has changed dramatically, such that actually a few weeks ago, we've had a very cold winter. The differential was at a record all-time high. It was over almost $1 a gallon diesel over retail diesel over retail gasoline, over regular grade gasoline. That spread has obviously come down a bit, 50 cents in the past few weeks. But we've kind of entered a new world where that spread, is that spread now going to stay here at 50 cents over gasoline, or are we going to revert back to, the classic revert back to the mean of 10 cents under? And this is kind of an unusual situation that it's a side effect of U.S. legislation. Again, it's not really discussed that much. People kind of think it's related to the fundamentals of the U.S. moving towards ultra-low sulfur diesel, but it's not. It's a side effect of U.S. legislation. of just an interesting thing to point out. But if you look at almost a third of the U.S. Oil consumption is diesel or distillate because it's used for trucking. So FedEx and UPS, they're paying this price, these diesel prices, and so they have not seen a full benefit of the fall in oil prices because they're still stuck at paying a much higher price for diesel.
So, I'll say a word on this. This topic has, again, been a subject of previous webinars of ours in days of yore, and it's particularly noteworthy now simply because Cushing's a mess. It's almost full. It just keeps getting more and more full. And the question is, what's the price response been relative to that? And the easiest thing that piques my interest is the next slide, which basically scatters inventory versus the Brent WTI price spread or ratio in this particular case. And what I find interesting, and I'm curious to know, Morgan, if you have any views of the matter, is that the red dot shows where we just were, like a recent day sometime, and inventories are way higher. And yet the ratio is a measure of how bad TI and the Cushing delivery is performing doesn't seem so out of whack. And in fact, just for the sake of conversation, if you go to the next one, this is segues into time spreads, but it's pertinent to the Cushing story. This is another way of looking at it, which is forward yields, which is viewing the futures curve as a yield curve effectively, are high. The higher the forward yield, the higher the next price is relative to the prompt month. And the higher it is, the more incentive there is to store. So it's a nice way of just looking at it from a yield perspective. And you can see in the astonishing days in early 2009, those yields annualized could clock north of 200%. It was a tasty time to own storage. Here, in spite of unprecedented levels, and I don't think Cushing's added that much storage capacity, I mean some, why is it only 50%? Given, if you go back to the first slide where we show the PAD 2 inventory 2 back, given that number, I mean that to me is I'm skeptical that it won't get worse. But
one of the things that I always think that is when you get to tank tops in terms of oil filling storage terminals, the ultimate storage for oil is leave the stuff in the ground. Don't actually produce it because you can just store it and you can produce it next year. So
production's going up still, even with rig count.
Yeah. But I would say that production's falling off at the margin, that we're not producing as much as we would have. That is almost oil being stored in the ground as competing with oil being stored in Cushing and other tank terminals. And so it's one of those things that at the edge or at the margin, oil is effectively, by reducing supplies in North Dakota and West Texas, oil is effectively, by not being produced, is kind of being stored to the ground as a proxy for being produced and stored in Cushing, Oklahoma.
Okay, but putting your trading hat on, yeah, would you be buying or selling Brent TI spreads or the time spread with WTI alone? What do you think is going to happen? Not to put you on the spot.
So TI it's a very unusual spread in that they're not really comparable things. You've got Brent is up in the North Sea. It's a waterborne crude. Yeah. WTI is landlocked, and so it's a function of a whole bunch of things other than the fact that they're very similar grades of oil. And one of them is kind of things is just the physical amount of storage available at Cushing. But another thing is the change in the pipeline system in the U.S. And so you're almost trading a little bit, or if you're trading like in a one year type range, 6 months from 1 year, you're kind of trading legislation as well as physical infrastructure being installed, and that kind of it's trading an operational or structural change in the market. But at the very front of the curve, where you've got the week-to-week inventory numbers coming out of the DOE, it's the thing that's effectively throwing into the mix right now is that the change in supply and production is almost I think, as important as as looking at the levels of inventory, and that's why people are looking at, and it's become kind of a recent celebrity number data point, the weekly rig counts, the big huge rig counts that no one used to look at until 3 or 4 months ago. That has almost become as important as the weekly DOEs, and so people are looking at it's a very, very new situation, and that if you look at just the inventories in isolation, you almost have to back up now into this new world of looking at inventories plus infrastructure change plus legislation. You know, there's that whole Keystone issue, which is kind of I think a minor issue in the bigger scheme of the oil market. But as well as you have to look at oil supply changes, which is happening. They're all happening simultaneously, and so the weekly inventory numbers, they used to be the big thing that would drive time spreads. I think that time spreads have become a lot more driven now by weekly supply changes, and the oil market has actually become a lot more like the nat gas market, in that nat gas, when those weekly numbers come out, those supply and inventory changes, the nat gas market on the supply side can turn very, very quickly. Oil, at least in North America, is becoming much more like that, in that oil supply used to be much more stable and trendy, and now it's become much more volatile in terms of the supply side. So looking at inventory, I think that in summary what I'm trying to say is that if you're trading just an inventory, it's become much more complicated to do that in the past 6 months to a year because of the drop in oil price. And so spread traders, you have to look at a lot more.
Right, absolutely.
And this is kind of just, I stuck this in here, this is the, if you look at, we've moved into a contango situation dramatically in the past 6 months. It's going to be, if you look at OECD, which is kind of the higher level, looking at not just the US, but looking at all the developed economies, there has been a strong relationship between the change in crude oil inventories and the shape of the forward curve. So this is kind of, we're going to have to, in order to go back into, to take this contango out of the market, it's not we're going to not have to just see a change in US oil inventories, we're going to have to see a change in global oil inventories.
So turning now to another arena in the energy commodity space, this is spark spreads. We're back to the story of PJM versus Henry Hub in this particular case. The plot here is known as a spark spread. It's common vernacular for power traders, but it's effectively the spread between the power price, again, rolling calendar strip, and 7 times the natural gas price. 7 is the magical number that's pretty close to what the workhorse combined cycle fleets produce at, a little better than that nowadays, but you get the point. And you can see that in spite of the sell-off, the spread between these things remain tolerably strong. By no means would you call these distressed spark spreads, at least in this tenor. And if you go to the next slide, this segues to what Michael was asking me about earlier, namely, how do heat rates, which is the ratio of power to natural gas, behave relative to the underlying natural gas price? I apologize for mislabeling the x-axis is natural gas prices. And this expansion is well known. As gas prices go down, the heat rate tends to expand. It's a metaphysical question as to exactly how much is due to what. But ultimately, if you're adding a fixed cost to an underlying 7 times the natural gas price, it'll exhibit behavior like this. Or if you have a stack model where you can switch into other commodities, into or out of them, that will also exhibit this behavior. What's important here, though, is that it's always intriguing to me how there's a spectrum of behavior as far as construction of hedging strategies among all the market participants, from IPPs to retailers to large generation owners and utilities. Is there's a tendency to be crafting hedges based upon the prevailing market heat rate, saying that if I want to hedge power and it's kind of illiquid, I don't like what I'm seeing, it seems like it's a little bit cheap relative to what I want, you'll hedge with natural gas, and the conversion will often be done at the market heat rate, at the ratio implied by the forward curves. And that answer is usually way, way off from what you really should be doing, because this this relationship here being shown simply changes the amount of natural gas you should be buying or selling, and it can do so meaningfully. And it's particularly important when you see sell-offs like we've seen, because when you're $2.50 natural gas prices versus double that, that really does change how much you should be buying or selling relative to a power book, and ultimately points to the need to be rebalancing along the way as prices have sold off. And one last thing on spreads. This is the next slide. I personally can't stop looking at the slide on the left ever since it transpired. And this is a little departure from the norm, but a spread's a spread, and equities are tradable things. So if you, the experiment here, done in both of these plots, is to take an energy ETF, XLE. It has a bunch of stuff in it, producers, Schlumbergers, all the usual things. It's intended to be a tradable item that roughly represents the amalgam of activities associated with energy. And if you regress that price against S&P and sort of strip out the equity component, and then you look at the residuals and plot them against oil prices. And here we did the first Brent nearby on the x-axis. You could do any nearby you want. Doesn't matter. All looks about the same. You can see during the previous big sell-off, namely the epoch of Q4 of 2008, Q1 of 2009, this residual was really weird. The energy world just simply outperformed relative to what you would have expected. And you can then proceed, like many people would do, to start looking for other explanatory variables. They're sort of hard to find, and ultimately I reached the conclusion, rightly or wrongly, it was some sort of flight to quality. You got oil in the ground, you have that sort of, it's ultimately an asset that you can hold that isn't going to go away. But in comparison now, you do the exact same thing. Similar price range, similar sell-off. For some reason, the dots are a different color, even though it was the same program that generated them. You see the red dot where we are now, but the point is the behavior is not nearly as beautifully linear as the other one, but certainly it's not anomalous. It doesn't appear to be anything like a flight to quality. It's behaving as you basically would expect if you threw a line through it. And so, it's just an interesting observation that in the last two sell-offs, one clearly, macroeconomic credit crisis driven versus arguably supply driven in this case, it points to pure supply and no other real, indications of this being part of a broader crisis.
Yeah, that's a very interesting. Yeah, I've never seen that actually. That before. It's very interesting. I was going to mention. Do you think that the strength of the dollar, all these commodities are dollar commodities, that has that played a part in the sell-off in dollar-denominated energy commodities?
I can't say that. Back in the day when we were looking at the one on the left, we tried a lot of explanatory variables, from FX to all kinds of things, credit default swap rates for that matter, just wondering if there's a difference here. And it was very hard to convince yourself that you had any explanatory part. If I say a stat arb strategy based on the left plot would either go very well or very badly depending on what you were doing. With regard to the current one, I haven't done that. It's an interesting thought to have a look and see how much of an effect that has nowadays. Good point.
So I guess one of the aspects of falling oil prices has been when prices fall by or rise by such a dramatic amount over a short period of time, there's the classic reaction of do you bear with it and leave your hedges in place, or do you start trading your hedge book? And there's been some classic examples over history of hedging books that have suddenly turned into trading strategies. And obviously the classic theory on hedging is that you don't trade whatsoever, and especially when there's a large unexpected price movement, because that is effectively what you've hedged for. And over the past 6 months, one of the most large hedge book changes, a hedge book that has suddenly turned into a trading situation, has been Continental Resources, and their ticker CLR. And these were the guys that kind of led, were at the vanguard of the U.S. oil fracking kind of revolution since 2009. They're the largest producer, one of the largest producers up in North Dakota, and they had a very large hedge portfolio up around $90, $100 per barrel. But then once oil prices started to sell off in August of last year, Continental Resources, when oil prices got to around 80, they unwound a large portion of their hedge book. And because they said, that's it, we're not going to sell off anymore, we're going to monetize this hedge portfolio and lock in that kind of $20 hedge benefit. And unfortunately for them, oil prices continued to sell off another $40. So it turned out that that was not, obviously, in hindsight, a great decision. But Glenn, what do you think of companies trying to stay disciplined when you have a large price move, there's a huge incentive, because all of a sudden they're sitting on hundreds of millions or some cases billions of dollars of mark-to-market benefit, and that's so tempting just to say, okay, this is no longer a hedge, we're going to monetize this, take that mark-to-market benefit, and turn the hedge into a trading strategy. I mean, that's a very tempting thing for any company.
Yeah, I'm sure it's tempting. I mean, we were in a prep call to this. We were using the oxymoron bullish hedging strategies. The thing that makes sure it's interesting, because it would be awfully tempting. You have presumably a pretty vanilla hedge on. You see all the money. On the other hand, it pays to go back in history and see how low can things go. They can sometimes go very low. And it's almost a rhetorical question in a way. The answer would be I don't particularly espouse bullish hedging strategies. Interestingly, though, I mean, if you go back, at least there was a dynamic response. There was some more saying, okay, now it's low, let's take the money. You can almost understand that. The thing I find it a little less perplexing than back in the day when, I mean, it's public record, with Chesapeake, you have the bullishness built into the hedge itself with the knockout aspect of your hedge. Your hedge is good only until you really need it, and then it goes away, which in a way it requires just a remarkable confidence in your ability to forecast the next several years of energy prices. So, yeah, I don't espouse either. The dynamic rebalancing, at least you're adapting to current information. You're not building it into the structure a priori. You know, so.
And then I guess another kind of infamous oil hedging strategy that is the Mexican government. Mexico is highly dependent on oil revenue. I can't remember the exact amount, but I think it's 40% of their tax base is linked to Pemex oil revenue, and they have, they've had this put strategy on for 10, 15 years, where every year they hedge the following year's production or tax revenue linked to oil production, and that's kind of served them well throughout the past 6 months at least. But then it's a very unusual situation where a government is hedging, but it kind of shows that having a hedging strategy is should be, I think, looked at as a very long-term play. Well, at least some people look at it as a long-term play. Other people kind of go in there and kind of trade it also.
Well, yeah, when we're talking to people, we espouse all the way across the board a reasonably scheduled and regimented hedging protocol, because timing the market is a very hard thing to do.
So where do you go from here? These absolute level price levels, I mean, moving forward, what's the motivation to hedge current prices?
Well, I think if you're a consumer, I mean, we're below the cost of production for a lot of U.S. production. So there's a kind of a pull towards higher prices, and we're well below the government budget rates of most OPEC countries, almost all of OPEC countries. So there's a natural tendency for us to be heading towards higher oil prices. But the challenge with kind of putting on a hedge right now is that if you scroll forward a few slides, there's volatility in the oil market is now at a very, very high level. So hedging with option strategies is very expensive, and there's kind of there's that kind of cost aspect to it, and also the forward curve is so steep, and that if you lock in, if you do a swap or a vanilla hedge, you're going to be locking in much higher prices than the spot price, which is, you've got to sell that to your board of directors. Why am I locking in $65 oil when WTI, the front of the curve, is only 50 or 55? So there are two big challenges, both driven by spreads. One is volatility spreads, and volatility itself having valued a lot in the last few months. And the second one is just the shape of the forward curve. If you're a consumer trying to hedge, it's a very tough thing to stomach.
Yeah. But if you're If you're a producer that's in trouble, it can be a different answer. I mean, we all, from GARP to any risk management, there's this reflex action of, kill risk, right? Hedging is the right thing to do. But, if you're starving, staying where you are is suboptimal. You'll go walk somewhere else, even if it might be drier, because it might actually have food. If you know you're in trouble, then waiting can be a perfectly rational thing to do. So you become risk propensive in situations like that. So it's not always the right answer from a corporate perspective.
In terms of liquidity, so with this large sell-off in oil liquidity is at all times rallied quite significantly, but unusually it did not. That liquidity kind of dried up more so in nat gas and power.
Yeah, well, I mean, that's probably due to a lot of the dealer exits from these particular markets. And, Michael and I were on a panel a couple of weeks ago at the GARP convention where this was a particular topic, because we've seen in all manner of contexts, but especially, for example, if you're developing an asset, you need to borrow hundreds of millions of dollars to build a combined cycle somewhere, and the lenders want you to have a hedge, and the hedge should look like the asset, but there aren't that many dealers offering a hedge that looks like the asset. So before long, you're allowing basis slippage to enter the picture, and ultimately it just puts sand in the gears of bona fide, legitimate, socially beneficial financial, risk transfer activities. And the dearth of liquidity within the power markets has been problematic.
Is that liquidity, the liquidity providers, is that because a lot of banks have gotten out of the
market? There are a lot of formerly power trading banks that no longer do it. The list is quite long. Yeah. But then the question is, who fills the void? There are others that are stepping in. You get the usual big names and the commodity shops. Credit ratings are, of course, an issue, credit support. But in the end, I don't think it's reached an equilibrium yet at all. I can simply say that I think that the experience of people within the markets. Here's an example. A few months ago, we got word from a quote from a dealer that I won't identify saying, quote, "We haven't seen Cal 18 PJM trade in months." To put it in perspective, if you went back a few years, the apex of market liquidity, the debate would have been, does it trade 10 years out or 12 years out, and is it 50 cents or $1? I'm being a little bit facetious there, but you never would have thought it had a positive probability to have the statement made that only a few years out, you haven't seen the apex of liquidity trade in months. That's problematic. People are full, and this needs to be resolved ultimately.
And spreads widen out, bid-ask spreads become
bid-offer spreads. If you haven't seen a trade, bid-offer spreads are a tad hard to really identify. But yes, but certainly the volume of transactions that you see. If you look at an ice cream, you'll see the end of PJM liquidity. I mean, I haven't seen one in the last week, but you'll see it end. It doesn't go on very far when you click the little live only button, right?
Yeah.
So it's different than oil and products at this point.
Do you think that is that going to change, or is there something underlying? Is there something like spreads widening, or is there something that's going to change that?
Well, yeah, I mean, the power markets have been through this before. You saw some similar collapse in the world, post Enron, Dynegy, Mirant, all that, and then banks stepped in. So the only question is who the heir apparents will be, or where it pops up again. The risk isn't going anywhere. Someone shoulders the risk, regardless of what regulatory regime you're in. Someone's going to pay for the risk, and so the idea of having intermediaries match them up makes sense. I mean, the core difficulty is you have, hedging programs that need to span a decade, plus or minus, and you have the natural shorts who are interested in the next year. So that ultimately, that stack and roll problem is something that dealers have done a lot to close.
Do you think that banks will ever get back into the power and that?
I can't conjecture. What do you think?
I don't think so. Not in the next 5 years, 10 years. I mean, a lot of it's due to legislation, Dodd-Frank, and all that.
Well, some banks are still doing it. I mean, the purpose of this is a bank's job is to make the illiquid liquid.
Yeah.
Whether you're lending, short-term deposits to long-term, borrowers, you could argue that this was accomplishing something similar and quite in line with what you'd expect them to do. But that view is not widely shared. So, who's to say?
It's just a quick overview of the increase in volatility implies front-month WTI vol over the past 6 months. They've been quite dramatic, and this goes into option pricing and that hedging with an option strategy has become much more expensive. If you go to the next, there's obviously a large skew to the downside in terms of put skew, and so it's if you're a producer buying puts here, it's become a lot more expensive over the past 6 months. And then, so
what happens next?
Again, you got three scenarios. Prices continue to fall across the entire energy complex, sideways, range bound, or higher.
You really stuck your neck out on those two there.
Sure. And so I guess I like the shell model of you should have, if you're a trader or hedger, you should have a range of probabilities assigned to each of these, and you should have pre-thought out your actions in each of these scenarios. And so prices continue to fall. In terms of oil, which is kind of I don't think that is a sustainable scenario. I think it's a low probability scenario, but still you may have the big risks here are China and Brazil. That's Russia's already off the rails, but China and Brazil's kind of off the rails. The big one here is China, that something happens there, but that has always been the risk for the past 20 years, every year. But if something happens in China, then that could drag oil prices lower. Sideways to range bound, that's probably obviously the most highest probability scenario, $50, $60 over the next few years, and that obviously will affect spreads in terms of the inventories are very high at the moment. If we see sideways oil prices, I think it's very hard to see time spreads being this wide for this long, because the market will eventually react by either producing less or building more storage. So that's kind of the highest probability event. And then higher prices, which I think will take a basic concerted effort with OPEC, Saudi Arabia, and Russia, which I say if there's kind of a one left field event that could bring oil prices above $100 in 2016. We're not going to see oil prices come even close to $100 in 2015. But if one left field event would be that Russia and the Saudis agreed to a cut. And one of the things people always forget is that in the November meeting, the Saudis were willing to consider a cut if Russia agreed. And basically Russia sent along, at least allegedly sent along Igor Sechin, who's the CEO of Rosneft, number 2 guy in Russia behind Putin. Some say number 1 guy ahead of Putin, but anyway, they sent him along, and they refused to go along with the Saudi proposed cut, even just a trivial cut, 500,000 barrels a day. But Russia have now kind of had more oil diplomacy outreach towards the Saudis in the past few weeks. And if all the Saudis and Russia need to do is take 1 million barrels per day off the oil, and I think that could get us back up to close to $100 within 2016. So those higher prices, a low probability event. But if you have a Russia-OPEC agreement, then that would become a much more likely scenario. In terms of gas and power,
well, just let's include on that. I'll just say one thing. I've been losing bets on when there's exit from the euro by Greece or others over and over again, year after year. But that's eventually going to happen. And there's no gunpowder left. We can't do much. Europe can't do much. China couldn't do much right now. So if shoes start falling there, I could see the scenario number 1. And so I'm sure I'll lose another lunch bet on this, but I'm saying 1.
And in terms of nat gas and coal and power, do you think that we're kind of in a low range band market?
Well, when we think of power, we think in terms of spreads, and when we have sort of big powwows about what's going to affect things, the topics really are very much along the lines of the impact of all the solar builds, things that are really going to turn things around, and wind. The environmental aspects, the renewable aspects are a big deal, as well as a demand response. So what's natural gas going to do? You have a better idea than I do. I hesitate to predict, but when it comes to the power's relationship to that, the dominant considerations are really these other factors, and they affect how you manage positions substantially. But that's a topic of I could go on for another hour on that. So
for the next, we do have one question from the audience that relates back to your discussion about the spread between diesel and gasoline.
Sure, yeah.
Somebody in the audience wanted you to expand on the legislative aspect of that and what's going on there?
Yeah, so in the U.S. in the 1970s, there was ban put on the export of crude oil. In the 1970s, obviously there was an Arab oil embargo. It was not an OPEC oil embargo. It was several Arab countries cut back production very dramatically. And the U.S. government reacted to higher oil prices by saying, hey, let's put a ban on any crude oil producer in the U.S. exporting crude oil. And that ban has stayed in place for up until it's still in place today. But the U.S. since 2009 has become a much larger crude oil producer. And a lot of that crude oil the U.S. oil refinery system is incapable of processing that crude oil. It's very light crude oil. And so the oil market kind of is like it rebalances internally itself. And one of the kind of unusual things about the oil market for the past 5 years has been Europe and the rest of the world has been a very large diesel consumer. The U.S. has always been a large gasoline consumer. And so the U.S. has kind of reacted to this increase in crude oil supply by processing or getting this oil out of the market via exporting it via diesel. Basically, it's kind of it's a process to enable the U.S. oil market to export oil. There's no ban on exporting refined products. So the U.S. oil producing system is exporting diesel as a proxy to get around the ban on crude oil exports. So it's kind of it's a side effect of legislation rather than there's no kind of other reason for diesel to be above $1 over gasoline.
Right. I think that sums it up very well. Thank you. I think we're done with the questions from the audience now. I have one last question for you both. This is sort of, I guess, a little self-serving given what we do here at GART. But from your perspective, what are some of the skills that you think are important in folks that manage risk in the energy markets and maybe the ERP program? Just, I know it's sort of a left field question, but I'm just curious if you have any thoughts on that. In your experiences.
Sure. I mean, usually in terms of risk management in commodities, not just oil, but nat gas and power, one of the skills that I would always say is one of the most valuable is understanding that energy, unlike other asset classes like rates or equities, managing risk in those areas, managing risk in energy, I would always, as a trader, have the utmost respect for a risk manager who would not just look at risk in dollar terms, financial terms, but could look at risk in unit terms, barrels or MMBTU or megawatt hours. And so most oil traders would say that when they kind of go home at night, they would say, I have this number of barrels at risk at the moment. They would never say it's this dollar amount. And so it's kind of a way of thinking about the market in terms of the underlying unit.
Understanding the physical nature.
Yeah, and so it's kind of hard to describe, but that's most energy traders think of their risk in the units, not the financial aspects.
Right.
And so having the ability of a risk manager to think in those unit terms, I always kind of thought was a very solid thing. But you obviously have to look at VAR and those kind of units also. But having the ability to know what does a 1 million barrel spread on this time spread, what does that mean versus, I have $200 million of VAR exposure or $220 million VAR exposure.
Right.
Yeah, I mean, I have two comments. One is that, ultimately, everyone becomes a statistician in this business one way or the other because the markets are illiquid and you have to trade one thing to hedge another regardless. Even with the liquidity and benchmarks in crude, a real crude book has all kinds of exposures that don't really trade. But going back earlier, the best way I think to answer the question is to go back to Morgan's discussion of why the forward yields on TI were not so easy to trade, and he hit a litany of things that were all impacting it. So all the math stuff aside, the ultimate risk manager is able to think through all those issues and ask the hard questions about what if this factor or that factor or the other. It may not even be characterizable statistically, but is able to keep track of these other issues. And I say that as like the full-blown propeller head on these things. So So I thought that discussion, I've seen a lot of risk managers come in and interview for positions, some very senior, and they get shot out of the saddle because they're doing too much of that. What if this, what if that? They're not towing the quantitative line per se. But the best risk managers are hybrid and are able to plunge into the nitty-gritty awful questions that are hard to fully characterize, like the ones you were bringing up.
And one thought is that sometimes the unexpected happens, and so a good risk manager should have, even though there's it's a 2 standard deviation move, a 3 standard deviation move. If you're trading oil, for example, or managing an oil desk, you should have in your mind at least some sense of, if you come in one morning and oil is $200 a barrel, or if you come in one morning and it's $15 a barrel, what happens? Does the whole company disappear? Or because those situations happen. If you're an airline managing risk or a risk manager at a brokerage shop, risk margin calls and that kind of thing, you've got to sit there and think that because one of those situations will happen every 10 years.
Right.
And so you've got to help. Obviously, you plan for a 1 standard deviation, 2 standard deviation move, but you should be prepared that you come in one morning and prices, without any trading, any liquidity, have just shifted to a new price, $200 oil or $15 oil, and what do you do in that situation?
Right, right. No, that's terrific. A great perspective, guys. I appreciate it. So that pretty much wraps up our discussion for the day. Again, thank you very much for joining us. And if you have participated, be sure to send us your credentials for having attended the webinar, and we'll be sure to give you credit for the CBD effort. Again, thanks very much, and have a great day. Thanks. Bye.